Now, the reason why it's so important is because most companies are not segregating your costs of goods from your direct labor. Surprisingly, they're kind of mushing these together. So you've got revenue, direct costs, and then gross margin. They're not segregating these. But if we don't segregate these, I have no idea what my product margin is. I have no idea what my direct labor as standalone looks like. And I don't get like I said, this is the engine. So if I can't take the engine apart, I really don't understand what's happening with the business, right? So why do we separate the COGS from direct labor? Well, as Greg Crabtree says, the author of Simple Numbers, check this book out. Labor is the only cost, okay, that comes to work with an attitude. Your COGS don't come to work with an attitude. Like your labor has a lot more of an ability to be optimized than your hard costs in most scenarios, right? So when you're talking about hard costs that you purchase from a vendor, there's much less wiggle room, right? And there's no like they're not a human being. It's just a hard cost of goods sold. But your direct labor, they're a human being. And you have the ability to help optimize that because there may be inefficiencies there, which is mistake number 5. But typically, for your gross margin, after your direct labor, after your cost of goods, that's going to eat up about 50% of your revenue. So after $1 million in revenue, for example, you're going to be left with $500,000. Okay. Now, in terms of your operating expenses, you can expect around 30 to 35% of revenue to be eaten up by OPEX, operating expenses, leaving you at the end of the day, when I go down to your net margin, with an ideal 15 to 20% net at the end of the day margin. For those that don't know, when I say net margin, I just mean we're basically taking the net income divided by your revenue. So if you had 150K in net profit divided by $1 million in revenue, that yields me 15% net margin. So we talked about the trifecta, and it's going to tell you if you're in good condition, you're in great condition, you're in a cautious position, right? All that means is that for rolling 3, for example, I'm combining the last 3 months of financials into one column. And rolling 12 is the same thing. I'm combining the last 12 months of data into one column. So for example, if I did rolling 3 for June, it would include April, May, and June together. I really don't understand, because when you look at the financials 1 month at a time, it is too narrow to get accurate data from that. You may have a huge boost of sales in June, a massive unexpected bill that's going to throw your profit margin trifecta out of whack when you look at it on a monthly basis.